space. Happy to talk about that another time. But I have been the beneficiary of lots of people over the years doing due diligence on managers that I've been involved with. And I have done lots of due diligence on managers that we look to invest in. So I have a good perspective on both sides.
Hi, I'm Ellen Baker, and I have a business called Baker Aurora, and we consult to family offices and introduce them to alternatives. I'm licensed with a broker-dealer, so I have to pay attention to FINRA, SEC, and go through an inordinate amount of due diligence. I focus primarily on little nuggets. Most of my clients have larger broker-dealers that give them things you can find on the internet. People come to me with really interesting nuggets. Maybe it's seed, a lot of tech, and very interesting things that happen to float my boat. So that's what I focus on and what I prefer. It's a lot of due diligence because they're new and innovative ideas.
Hi, I'm Lindsay Sashelle. Happy Veterans Day, and thank you to all the veterans. Thank you, Howie, for hosting, and thank you, Marty, for having us. So my background spans alternative investments for the past 20 years. I've kind of swung both ways on this one. I've been at the manager side and a long time on the allocator side. I spent some time at Goldman Sachs, D.E. Shaw, a fund of funds, which now call themselves a multifamily office because everybody's doing that these days. And most recently aligned with one of the family offices that helped build the World Financial Center, helping them in their own version of intergenerational transfer, navigate alternatives as it evolves and intersects with changing markets. And that's really where I've kind of found my niche. It's focusing on the intersection with paradigm shifts going on in the industry with intergenerational transfer, longevity focus, and how the money flows are actually impacting allocation decisions, and also how the allocations themselves are evolving to provide unique, actually uncorrelated opportunities. So I'm excited for this discussion with great panelists. Happy to share the mic.
Thank you. Anytime. So I've been a fund manager for 41 years. Honestly, the first 20, I was inside captive capital and European family offices, running a hedge fund and 3 venture funds, and we used no outside money. But I made up for that. In 2004, I went to State Street and built and ran the global fund of hedge funds for 15 years. We've hired 200 managers in 26 countries across asset classes, not to mention the thousands and thousands. So manager selection. And by the way, for me, there's maybe due diligence, but for me, coming from an alpha panel to manager selection panel is a natural sort of movement because that's the way we did business. The last 9 years went back to family offices. Again, manager selection from a different point of view. We only do co-invests. We only work with managers, invest in managers that we can work with, whether it could be managers, could be a company, could be a lot of things, but call it manager selection, but from a very different perspective.
Yeah, and my name is Howie Con. I'm an advisor with Strategies for Wealth, and I work primarily with high net worth families, entrepreneurs on tax strategy and multi-generational planning. Happy to talk to anybody about that. Also, I know nobody ever wants to sit in the front row, but there are a bunch of seats here in the front row. If anybody would like to not have to stand, but nobody wants to sit in the front row anyplace. Yeah. So piggybacking on the previous discussion, I think we can start off with how AI has impacted manager selection and what role AI is actually playing in this now. Because as was pointed out in the previous panel, human interaction is still very important. You can't just rely on AI. So Lindsay, you got the mic. Let's
with the mic. No, but I'll jump in. I'll jump in with a kind of a question here. Who uses ChatGPT as their bot? Okay. Who uses Claude?
Who's Claude?
Who uses something else, some other bot? Okay. Yeah. Okay. Who uses nothing? Like not a thing. Okay. So that's fewer than 5, right? So it just goes to show that in a very short period, how reliant we've become individually upon AI to do mundane and some very serious tasks, actually. And there's probably some inherent risk there that we can come back to. But in terms of how AI works within a family office or allocators organization, I think about it as broken down on 3 levels. The organizational level, how is AI integrating into systems, making processes more efficient, accounting systems, proprietary systems, expenses, all of those elements. Then there's the investment due diligence component, which AI really can pick through a data room really quickly. I'll caveat that with there should be guidelines in human intervention or checking of facts, because I've asked my Claude the same thing twice, and it's come up with 2 very different answers, and I've had to ask them Claude to justify it. And then there's the personal use of it. So how is it impacting investments? There's different ways. How is it being integrated into diligence, and how actually are we as a family actually embracing and investing in AI as it intersects with other technologies? Because AI is ubiquitous, right? Is it AI and digital infrastructure? Is it AI and healthcare technology? So there are many ways to AI is impacting almost everything. And in terms of this whole AI or die, the other day I was walking by Rockefeller Center, and there was this robot dog, and it was crazy. Everybody was surrounding this robot dog as it was doing tricks and was like fascinated by it. That's kind of scary. I personally don't think it's AI or die. And I heard this professor from Stanford, Eng, say it as, and I have kids, so it resonates a lot, but like ratatouille, like the rat under your hat. So it's kind of AI can be your guide, but with caveats. And I'll pose forth the following, situation that can realistically happen now, right? Let's say there's an analyst on the investment team that relies on AI to due diligence company, or a manager for investment puts together a beautiful case that answers all the questions, on the DDQ or whatever it might be. That then is approved by the investment committee. Investment is made, and family members, clients, whoever it is, are pissed off because the investment goes haywire. Like, who's at fault for that? You're not going to blame like ChatGPT for that, right? Is it the analyst's fault for not disclosing the use of AI? Is it the investment committee? Is it the firm's fault? So, and there are folks working on this. I have a friend who's actually working with IBM and certain medical institutions to think about great proper governance frameworks. So it's a powerful tool, both actually investing and how it can be utilized by our family office, but with some guardrails and boundaries. But there's tremendous opportunities there.
I just want to piggyback off what you're saying and address the fact that a couple things. There definitely has to be human intervention with AI. And I am a host of Resilient Alpha, which Mark did a great job of plugging earlier, but we use AI to generate some of the questionnaires when we're interviewing someone. And I have found that sometimes the questionnaires are spot on. I have also found that sometimes the questionnaires are 100% off, and I have to redo the entire thing. So you really have to look at the output from AI. I can also tell you that when we went to parent teacher night at my daughter's school, the math teacher reminded us to remind our daughters not to use AI because AI doesn't know how to do math. So there is a use in terms of speeding up processes. Can analysts, so I think when you're doing manager due diligence, you want to, first of all, on the manager side, understand in what circumstances and how the manager is using AI and what kind of oversight is there after the work product is produced. It certainly can create efficiencies for managers, perhaps a smaller staff. I mean, the world has changed. When I started on Wall Street, we sat at the printer all night long waiting for prospectuses to be printed, right? We had to sit there until they were ready and check them before they could be delivered. Obviously, we've come a long way since then. So there are things that can make analysts' jobs quicker, smoother, faster. That's important, but then it has to be checked because, as the math teacher said, AI doesn't know how to do math. On the flip side, you can use AI to do things like background checks, to understand, to weed through quickly legal filings to find out if a manager has any legal issues, things like that. But then you have to trust but verify, And, that's what I tell people about in any kind of due diligence. I had a phone call yesterday from a friend who is looking to do some business with a manager. And he saw on LinkedIn that I was connected to somebody who used to work there. And he called me and said, "What do you know about this place? What do you know about this guy?" And you gotta go that extra mile. And Chat GPT isn't gonna do that for you.
Andy?
So
And by the way, that's where people got caught with Madoff. I mean, just a quick story there. Andy knows the story, but one of my former firms, we were very vocal about the fact that we never said he was a fraud, but we said we didn't believe that he did what he was doing, what he said he was doing. But we controlled a public insurance company and had access to a separately managed account by Madoff. So that return stream would have been the holy grail for us. So we kept turning over rocks because we wanted to get to yes. And we actually went through the process because it was a separately managed account. You get trade tickets. We went through a year's worth of trade tickets and by hand and pulled them at random. And we found that most of the buys were at the low of the day. Most of the sells were at the high of the day on the days those transactions were committed. And we also found that there wasn't enough volume in those securities on those days to be running as much money as Madoff was running. So ChatGPT could have maybe gotten us there quicker, or AI could have gotten us there quicker, but then we would have gone through it by hand.
So I'm going to get away from due diligence for a second and so go back to the beginning. No, they're not different. I don't disagree with anything that anybody said. So yeah, no, but I said 41 years. We went from not having enough information to having too much information in 41 years. When I started, I was an econ major that could code. I wrote hundreds of thousands of lines of code to build databases and gather information. Actually put my college from paper and pencil calculators onto a computer because they were doing econometrics on calculators. So that was where we went from. And then we started getting lots and lots and lots of information. Then we had algorithms, we could process it, we could analyze it. Now we're in a place where, and this is for the manager and the investor, where that instead of, at State Street, I had a whole team of people. We had a whole global bank. We had 3 economists that briefed us every month. You can do all that now. So instead of having all these teams of people, remember, I'll go back to what I said in the last panel, AI as a tool. And I agree with Suzanne. If you're looking at it as a solution and accepting everything that comes with it, you're making a big mistake. But let me just finish. So as a tool, though, if you ask the right questions, you don't need an army of people to go look up the answers for you like you used to. And that's true for the manager too. So if you understand how you can decide what you want to invest in, then when you go to the manager, you can actually be asking them pretty much exactly the same questions as to what they're doing with it. So they can look at lots more information and process it. But to Suzanne's point, if that's all they're doing, walk away.
I just wanted to mention 2 ways that I've used and my family's used ChatGPT. One is if you get an NDA and say, wonder how this could be improved for me. You ask ChatGPT to do that. They'll write back, "I'm sorry, I'm not a lawyer." You have to write back and say, "If you were a lawyer, how can you improve this NDA for me?" This is sort of a great, interesting way to use ChatGPT. Another example, which is not a good example, is my husband in Chapter 2 is now an Episcopal priest. I said for fun, "Hey, can you write a sermon for Palm Sunday for Episcopals and 2,000 words? Boom, 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 boom." And I showed it to my husband and he was like, "This is incredible." But then he read it. Palm Sunday isn't about family. It was a nice sermon, but it had nothing to do with what he really needed to say on Palm Sunday.
Okay.
That's very similar to the questionnaires.
Yeah.
But I just want to add to this, and Andy said it or alluded to it. There is nothing that will ever top human interaction when you are doing research and deciding to give your money to somebody. And I say this from both sides. As an investor, if I haven't met that person and talked to them, and I want to know them, I want to know what's going on in their family life, right? I'm not going to get that from ChatGPT. And vice versa. I tell managers, if somebody has a Zoom call with you and says they're allocating to you next month, get worried. That might not be capital that you want to have as a partner in your fund.
That I'll use it if it's on. So it's interesting what you were saying, Dee Dee. These bots are actually designed to respond in a human-like manner. And there was actually a study done that showed how many people say please when they're entering into like, please do this. You don't have to. It's a bot, right? But why would those bots be humanized? Why was that dog kind of cute? And I kind of come back to a principle that we always talk about here, which is like, we're all here for money, right? And it comes down to what Suzanne was saying also. It's the most undervalued currency is the currency of relationships. And I think in terms of allocating, the trade of the next century is going to be the FX trade on the compounding of those relationships. Because with AI, and I was talking to the head of one of the really big RIAs, like it's a multi-billion-dollar IRA. We were joking about how LinkedIn is just going to be like AI, 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 AI. It's going to drive back to actual relationships. The differentiating edge is going to be the conversations you have, how managers interact in good periods and bad periods. Are they delivering upon their mission statement, right? More inclined to stay with a manager that is underperforming when they're supposed to than a manager that's outperforming when they shouldn't be. And also, private equity, for example, for our family office, over the past several years, where a lot of people have been challenged by it, and it's definitely upended the Yale endowment model, which is a whole other conversation, has given us more of a look-see into the book-see, right? So before everybody's chasing private equity because you have to get in before the fund closes, and it's almost that Madoff-like envy, right? We have to get in, we have to get in. Well, now how are these managers handling it? That their models are performing in like one of the stress case scenarios. They're not returning capital, and they're looking for new flows or capital or selling on the secondary. And it's interesting to interact with those managers and see how they actually behave. But bringing it back one more level, when it comes to making manager selection decisions, it really starts with what is the core focus? What is the mission statement? What is one trying to accomplish, right? So here I'll use the example of Opus Capital, the family office that is most recently aligned with to help them focus on strategy and capital formation. So they have a booming real estate portfolio. So for us in that situation, our alternatives portfolio, the mission was to not lose money, like old school Warren Buffett, do not lose money, right? So the managers we were seeking, consistent returns. So in that instance, flashier managers might not have a role as good as they might be, but it really comes to what is the purpose you're setting, setting processes around that. And then, and Andy, you've heard this before, but the quick strategy from an allocation perspective is 4, 3, 2, 1, right? Make sure people, 4 P's, people, process, performance, philosophy, right? Make sure that they're all lined up and understood and that questions are asked. The 3 whys have to be answered. And this is good for emerging managers that are sitting out there, but also folks that are looking to analyze different managers. And think about it. And I think about this in the way I took a company public, which I forgot to mention. But in laying out the why for that, it's why this, why now, and why us, right? So it was a farmland company that I took public, and I still remember we only needed 1 page, and I don't even need to show it to you, to lay the case for why farmland. It was like population, land. Does everybody need to eat? Okay. So it was like there was very compelling, then it came down to why us versus other folks out there. So the why this, why us, why now. Why now is really going to drive where capital flows, because perennial funds sometimes get the boot a little bit because they can always be revisited versus the squeaky wheel that actually needs capital allocation now. So 4, 3, 2, two-way communication, and that should actually be 3. Communication should really be proactive, reactive, and interactive, but certainly should be 2-way. And it should not just be like managers upselling to investors and investors seeking allocations. It's really just this relationship that grows over time, because investments come from trust. And that's where the longevity for longer term investors, the stickiness comes from that as well. And then one defined value proposition, right? What is the actual value proposition? Like, why are you here? Like, what's your point? And if you can't answer some of those questions, for us, Madoff didn't pass like the GOTR test, the get out of the room questions, right? It was his auditor was like, for somebody of that size and quality and caliber, was just like, it didn't make any sense. And there wasn't a really good answer for it. So always have an answer, or just don't take the meeting yet, right? So those are some ways to think about allocation. but it
I
really
would
starts with
frame
the
that a
whole
little
thing.
bit differently. Always have a good answer,
Yes,
not just an answer. And
not blank face.
I think that some of what we need, bringing this back to manager due diligence and what we think about when we're allocating to managers, is one of the hardest things to do in our business is determining whether a manager is lucky or truly skilled. Because what the SEC makes you put on the front cover of your promotional materials is past performance is not a good indicator of future results. And investment management may be the only business where that is true, right? Because if you're a company that makes widgets, unless your factory breaks down, you probably make good widgets tomorrow that you made yesterday. Why does a manager have good performance for 3, 5, 7 years and then all of a sudden not? Well, there are a lot of reasons for that. And I tell managers, I don't want to see your performance on the second page of your deck. I want to see it as the last page, because that performance is a result of your process. And in order to figure out if you're lucky or truly skilled, right? Because it's that old Wall Street Journal thing about darts at a dartboard. You can do that for 7 years until you get a bunch of bad choices. I'm simplifying the explanation, but the point is the process has to be repeatable and sustainable over a period of time, and metrics need to be put around that. How many investment decisions is the manager making, right? If a manager is making 10 decisions a year and is right on 6 and the performance is good, is that more or less valuable than a manager who makes 100 decisions and is right on 60? I would argue the latter manager is showing greater skill, because 6 out of 10 can be more of a function than luck than 60 out of 100. So these are all the things we think about when we're looking to allocate.
Marty, you have a question?
I just had a quick question. I get these emails like every other day, but so somebody sent me an email who I've known raising capital for a hedge fund. He's been raising money for his hedge fund forever. And he says, please be informed, we have validated our solution with prospective clients and received a $350 million soft verbal commitment for our investment strategy from a US-based multi-manager on a first loss capital basis. As a co-investment amount of $35 million and $5 million for operating costs, we are raising $40 million, expected $200 million payout, $7 million of revenue per month after we go live. So I said, well, this sounds great. How much money do you manage? Oh, we manage $0.
Marty, and it's a first loss deal. What
That was
means
the
to
other. That was the
audience
other
is
part of it.
The
yes.
manager is responsible for the loss, not the investor. So that may not be so.
But I haven't even finished. The multi-manager
sorry.
is Scale Builder LP, and they are backed by Allocating AG of Switzerland. I mean, that's a legitimate group. So, but I'm just saying, it's. I don't know if AI wrote this note or what.
Well,
It's like a note that lots of big numbers, and then how much do you manage? Nothing.
Yeah, it's and the other one, there's all red flags like that. Like there's a manager that sends me emails all the time with an emoji of trophies and dollar signs in the subject line. Like right there, I'm like, bye. That's just too scary for words. So, you want to be, I think, thoughtful about that. But always remember too, when you're doing due diligence. So this friend of mine who called me and asked me about this person on LinkedIn was explaining to me the strategy that they're employing. And I'm like, okay, that sounds way too good to be true. If anything sounds way too good to be true, you need to do twice as much work, if not 3 or 4 times as much work, right? That's like Madoff. And this was like, oh, well, the only risk is they put your money in treasuries and then they use it as a bank to do this and that. And I'm like, how long have they been doing this? 3 years. Now, the principal in this case has a lot of his own money and supposedly is doing it, but they haven't raised any money. So that's a red flag to Marty's point. If somebody's got this great thing and they've been at it for 3-4 years and have this track record and haven't raised money, somebody else has done work that didn't come up so good.
Well, Suzanne, and I wanted to go. So we spent the entire day talking about opportunity, And it was a good lead in to managers, also about risk. And so one of the basic simple approaches, once you're not there unless you like the opportunity. Why would you even have a meeting, right? You like something about it. Okay. So we just had 2 examples of talking about situations that on the surface look like high risk. And I agree with Suzanne. You don't just write it off, but you do twice as much work. We pitched Madoff 3 times. I traded options for 12 years. I said, we cannot understand how you make money. Ask them questions. They couldn't answer the questions. Never even got to due diligence. Just, if I don't understand how you make money, then we can work on it. So if you don't understand the manager, why would you invest in them? Even they could be great. But if you don't understand what you're investing in, you don't even know the risk you're taking. So now let's look at risk from another perspective. Okay, I always say about specialty finance, now called direct lending. I hate the word. The long-term returns, long-term, are defined by your recovery of losses, not by the loans that you make. Okay, so when you go and you say, well, what's your recovery process? How many workouts have you done? What's your recovery rate? So in the last 10 years, when not so many happened, people are like, we don't have that yet. You know, I'm old enough. 2006 was all blow up in direct lending. So, but you can go to every strategy, whatever it may be, and sit there. And so the last one I'll tell you, which was really simple, made off things. So we did The Big Short. And, the way we did it, you wouldn't make a movie, it'd be too boring. But one of the meetings was with a manager who was investing in mortgages and had the whole strategy and had a great track record, making a lot of money, all that. And one of my questions near the end was, okay, that's a great story. What are you going to do if this doesn't work? If it goes wrong, what is your plan if it stops working? His answer was, this is the end of the meeting, forever. His answer was, can't happen. So talk about red flags. If you never thought about how you can be wrong or what you're going to do about it or how you could lose money, that's a very simple one to walk away from. So
yeah.
I was just going to piggyback off that and say another great question I think that a lot of people don't ask is the following. So the manager explains to you their process, you've determined it's repeatable and sustainable, and they've done 10% returns, making up a number. What did they underwrite those investments to? Because if they underwrote the investments thinking they were going to make 20 and only made 10, I would argue that's not a really good result. So you really want to understand not only what the result was, but what the initial investments were underwritten to on the front end.
Yeah, I'll jump in on that and just bring it up to more of a procedural level. One of the things that we're looking for managers is to have a defined, repeatable process for sourcing, diligencing, and allocating to whatever the investment is, right? A hedge fund, private equity, venture, whatever the case may be. We too also have a repeatable process, right? Some way we're sourcing based on some sort of criteria, downside protection, seeking risk, whatever the case it may be. However, we define risk, right? And then matching that to how you as potential managers that we're selecting also define risk. But then there's this initial layer of due diligence. There's more detailed due diligence, and that due diligence, just so you understand how, especially as family offices and other allocators become more institutional, is bifurcated, right? So theoretically, at many of the institutions and family offices that I've been at, there's an investment team, and then there's a separate operational due diligence team that has veto rights over the investment, so that there's no conflicts of managing. This has standards alone on investment metrics, but maybe fails operationally, right? Doesn't have the right checks and balances in place. So it's the bifurcation there, and then it's the ongoing monitoring, right? So what happens after the fact is how is, as all of us have touched on, how is the manager performing based on expectations? One question I always ask without fail is what keeps you up at night, right? You know, and I don't want to really ever hear that a manager or nobody should be sleeping well. Like there's too much going on to be sleeping well, but you can sleep okay knowing you have the right, you know, is it risk loss parameters or how you're managing your investments to work out okay. I mean, I will bring up this quote, forever, I thought, and I was pre-med, that Darwin said it was like the fittest, survival of the fittest, but it's actually not. It's not that the strongest or the most intelligent that survive. It's those that are most adaptable to change. And so what we're seeing now with all is a lot of change happening in the marketplace. Who's controlling the capital allocation decisions, right? Now it's not necessarily any longer the Yale and Harvard and endowments driving those capital flows, coming down more to family offices. So it's how the managers themselves are adapting to the change of the fact that in the markets now, volatility is probably the most persistent, attribute.
And I think that's a good point going back to manager due diligence. Over time, as managers grow and become bigger, certain things happen. The manager may have more of his own money invested in his strategy, which may dampen his tolerance for risk. He may have decided he needs more people around, he or she needs more people around them to execute the investment process. And I'll give you an example. I'm invested with one manager. I've been invested with him since day one he launched. And as he grew, he decided he needed a bigger investment team and outsourced some of the ideas. And he had one or two, not bad years, but mediocre years. And he realized that he was giving people that were not as good as he was decision-making power, and it was affecting his returns. He got rid of everybody, went back to being in control himself. And the last 2 years, performance went right back to where it needed to be and should be. And so you want to understand that too, how an organization changes and shifts over time. And then just going back to Andy's comment about risk, it's also one of the big factors that people don't pay enough attention to is the use of leverage, how it's used, why it's used, what it's used for. I often, coming from the credit side, I'm on a panel about credit and I've got real estate investors with me and I'm talking about unlevered returns. Their returns sound a little bit better than what we're trying to do, but they're 3 times levered and we use none. So you need to understand that as well.
And to that point, before you go, another one with process, before you go through the whole process and before the meeting, make a list of your questions and just think of one thing before you go through the whole process, because you may not need to. How can catastrophic loss of capital happen in this strategy? This is what Suzanne picked leverage. It's just one way. There's many ways. So before you go through all these checklists and all this kind of background checks and all this stuff, the first thing you want to do is say, am I comfortable with that factor that there's always something in the world that can create catastrophic loss of capital, but where is it in what I'm investing in this manager? And then you can go through everything else, because that sometimes I found was a quick way to just walk away from something because I wasn't comfortable with that. Marty's got.
So I do have a quick question, which is Lindsay actually brought up the point. So it would be great if you guys could talk about the lay of the land in terms of investing, because a lot of people say that the pension funds and the endowments and foundations have gorged themselves on alternatives, and a lot of them are just stuck and really not investing too much anymore in those strategies. That's number one. Number two, I was talking to a guy who's like a massive OCIO out of Los Angeles, and he told me that the business for OCIOs is no longer pension funds, because defined benefit pension funds and number of how many there are going away. They're shrinking, right? And so the business he says is in family offices. I'm just saying, so family offices wield more power, et cetera.
I'll jump in on this one first, and I'll just throw out some numbers right there. $124 trillion is changing hands from boomers to different cohorts. 40-something trillion is going to older women, surviving spouses, gray-haired divorces, and not because of any reflection of intellect, but because of generational dynamics, tend to be less financially literate than younger generations are. And 70% of them fired their RIA or financial advisor because there's no trust there. I was speaking to a friend just last week who is an executive at a bank that rhymes with Schmelz Fargo, and they lost $1 billion account because the widow did not have a relationship with the financial advisor. So you think about 40 trillion going to older women who don't necessarily have the tight relationship, 40 or 50 trillion going to Gen Xers and millennials. I'm like on the border of being Gen X and millennials, so I can choose to have one foot in both doors. But both of those cohorts, a lot of that money thinks about allocating very differently than the folks that invested prior. So that's one thing. Two, going back to your question about the endowment model, Yes, years ago, I remember it was everybody's trying to mimic the Yale endowment, right? And I went to Cornell, and I'd even be visiting with the Cornell investment office, and they'd be like, "Well, we're not Harvard or Yale, but," and what's happening now is over allocated to, or not necessarily over allocated, made a strategic investment in private equity that isn't returning. And so they're stuck with a lot of private equity too. In terms of the returns that were being shared with everybody, they were based on models, right? So they weren't necessarily the most accurate of returns, right? They were hypothetical.
But the biggest problem is what you just said. It's the return of capital, particularly in
Right.
private equity. You used to be able to pretty effectively model out when you were going to get your capital back. And Marty and I were talking to somebody in the last week or two who said he hasn't gotten one check from one of his private equity investments in over a year, right? You used to see return on capital pretty steadily over the life of a fund. And all of a sudden it's just been stuck. So there hasn't been new capital from foundations and
So,
endowments.
Marty, so to your point, Henry Kravis, by the way, 2 weeks ago said the private equity model is broken. So I'll just quote him. But Marty,
But by the way,
benefit-
that's why all the big guys are going after
No,
401ks
I'm agreeing with you.
because they're
So, but to Marty's point, Marty, one thing you're missing, guy has spent 15 years at State Street, is defined benefit plans shrinking. They have
The number.
wait, the biggest sovereign wealth manager on the planet, endowments, foundations, family offices are creating not little play foundations anymore, but whole operations. So the institutional aspect of this, although defined benefit plans used to dominate, it hasn't gone away by any stretch of the imagination.
I would like to,
Oh yeah.
Just-
Sorry, I just want to get one word in advice and then I'll let you, Howie, I promise. Because the final part of the question was actually opportunities. So yes, OCIOs are basically going away. Consultants are basically gone as an industry. They're all redefining themselves as OCIOs, and OCIOs are now pitching themselves more to help institutionalize the family office market, and especially angling towards younger cohorts and women, right? So that's all happening. In terms of opportunities, one, again, core fundamental, what is it that the purpose of the return serving in your portfolio? That should be what drives the allocation decisions. But where are opportunities? Truly uncorrelated investments that are probably an actual hybridization structure, something that can deliver private equity or, like returns, but with actual return of capital in some reasonable time frame. And those opportunities exist. There's some, one we're constantly reviewing and have investments is litigation financing. It's just truly I just went through a divorce. People fight in good times, people fight more in bad times. Litigation is a strategy that is always making money, completely uncorrelated and always going on. Other interesting strategies of the moment are, and I know one investment that's doing this, taking an agnostic view, for example, on the RIA space. So buying minority and even majority shares across the board. So taking a view that it doesn't matter which wins, which acquires more, which one loses, but understanding the notion that as boomers retire, financial advisors, I think 40% of financial advisors are set to retire in the next 10 years. They control about 60% of the assets, right? So there's a lot of opportunity to invest in that segment that's happening across other, I would say, sectors that are a little bit more ubiquitous. So there are entities that are doing that across accounting firms and other service providers as well. There's a huge opportunity, digital infrastructure and defense. Is a very good opportunity that is actually delivering upon returns and some interesting structures there.
Yeah.
Yeah, sorry. And then I have a bubble, but I'll get into that. Sorry, Howie.
So,
Okay, so what-
Howard, the one thing here, because we should have started with this, by the way. I'm going to say one sentence.
okay.
In the world of uncertainty, which is where we started this, manager selection is way more important than it was a decade ago when nothing was going wrong.
I disagree with that. I think manager selection is always important because one of my very early bosses said it's much more important to miss a bad manager than get a good one. It's the whole concept about never lose money, never lose money. So manager selection has always been
Risk and
paramount.
uncertainty.
So
Howie.
to that no more words edgewise. So to that point, Suzanne, we discussed something the other day, which I felt was really interesting, which is when you're interviewing and deciding on managers, what's their spot in life? What's their place in life? Is there a difference between looking and interviewing men versus interviewing women, and how that affects the decision-making process? So I'd like to hear from you, from Ellen.
I get it. I'm not talking on this one.
I
mean,
hired female hedge fund managers, so yeah.
it goes back to what I was saying before, like getting to know the people that are involved in running the money and knowing what's going on in their lives. One of the pieces of advice my father gave me early on is never invest with a manager who's getting a divorce, because they're going to be distracted. Divorce is emotional, painful. Your focus might be, your kids might be getting all screwed up because of it. Other things going on. I'm going to get vilified for saying this, but I am going to say it. I don't tend to like women running firms that are in very actively traded strategies. Now, this is just a personal bias. I know that if I was running a portfolio where I owned IBM, let's say, and IBM's earnings come out and there's something wrong and I've got to get on that earnings call. But 5 minutes before the earnings call, the nurse at my daughter's school calls and says, your kid just broke her nose. I'm going to my child, right? A man, I'm sorry, can stay there and concentrate on that call. Mostly, I'm making a broad generalization. Private equity, venture capital, things with longer time horizons that don't require knee-jerk decisions, very different. I think women are very good at it, and maybe sometimes better, because women can be more thoughtful. But highly volatile trading strategies, I'm much more comfortable with a man. That's just me.
Well, and look, as venture capital, where the moment-to-moment decision isn't making anything, and go to the school meeting. By the way,
And private equity is the same.
both my ex-wives were in the business. I love it. And I'm telling you, it's a whole different panel. You should put me on the women's panel, because I can tell you horror stories, because it was terrible. But I don't disagree with what you're saying. We did have one distressed debt manager, woman, absolutely fantastic, one of the best I've ever met. Some of these exceptions, of course.
There's always exceptions
but
to
the
a
flip
rule.
side is the other thing that you say, because we don't just invest in hedge fund, venture capital, businesses, other things. There's some women that really do a fantastic job of running those funds.
But I think
I'm going to say Urban Innovation Fund is a great fund run by women. But any commentary on the fact that there's 15,000?
But again, that's more on the private side.
They're amazing. Yeah.
Right.
Any comment on the fact that there's 15,000 private equity funds and only 5,000 have raised capital for a new fund in the last 7 years?
Yeah. I just said, Henry Kravis said 2 weeks ago,
Because they're still working on their other funds.
Suzanne just said you can't get any money back.
That's my commentary, right? Because somebody said there's going to be a reckoning.
Marty, what was my prediction? You asked me. What was my prediction?
Were you the reckoning guy?
I said venture capital and private equity by the end of 2026 will be completely
You're the
different
guy.
industries than what you see today. That was my prediction I just gave you today.
You're right.
There'll be a lot of hybridization structures. I think, and I'm just going to take different angles on it. Historically, when allocating to managers across different strategies, hedge funds, private, whatever the case may be, tended to be more agnostic to if it's male or female. It's more what are the net returns, and focused on that. In terms of acronyms like ESG and DEI and all those have come up. ESG was just a messed up acronym altogether, and people, in my opinion, viewed environment to like mask the whole social and governance, which was actually probably a little bit more important in terms of how investments play out. And in terms of DEI, I was on a panel for Women's Investment Month back on March, and it was like, whoa, DEI went away. What are we all going to do? But like, we don't need the acronym to do the things. But more agnostic there. Where I do think we're going to see a difference is more women are making the investment decisions, right? So there's going to be more. And then I'm going to get to a bubble that I think is forming in private equity. So what's going to happen, and I'm already beginning to see it, is, for example, philanthropy or legacy-based investing, values-based investing. It's not solely investment objectives, to your point, that are necessarily driving allocations
and I think that it's really important not to have things like DEI or ESG dominate the investment decision. I mean, we're in this business to make money. And I remember I was at a round table and there was discussion of a lot of the historically Black universities have moved to a model where over 50% of the assets in their endowment have to be invested by minority owned firms. That's putting those endowments at a real detriment just because of the number of firms that there are and the number of good ones that there are. I mean, it's just.
So Suzanne,
But
for
Ellen,
no,
gotta get Ellen
I
in
live
this.
this. I live this for a decade. Howard University, we ran half the alts in both the endowment and their pension plan. And this was when they didn't have any money. Like when Kamala Harris came, everybody discovered it and they got some money. They had no money. They came to us. We actually had to have a managed account for them to keep the risk so low because we were already low risk. We had to have their assets separate. So I knew them really well. I spoke at the business school. That everybody speaks at Columbia. No line at Howard University. Go speak at the business school. I took interns, et cetera. So I know this like really well. They came to us with exactly the question. They were like, we don't want you to compromise your strategy. They said that. The investment committee said that. They said, but are there minority managers that you could possibly hire? And I said, listen, I am so indifferent to who runs it. I said, we have a woman was our best distressed step manager, whatever. But I said, we know like thousands and thousands of managers that we meet with. There's only one I know. They kind of just started up. I think they're pretty good and they don't fit the strategy. So the simple fact was there wasn't a lot to pick from to create that good portfolio. And I contribute to one of those groups. And I said, the problem was there were no Black analysts who became Black junior portfolio managers, who became portfolio managers, who could run a hedge fund. And by the way, I don't care what color you are, getting to run a hedge fund is a really hard thing to do. The failure rate is immense. So that whole process just didn't begin. And today it's slowly getting better. But when you top down, which Howard would not do, when you top down, force that on something, you are compromised.
I'll jump on top of that. Oh, yeah, sorry. Yeah, sorry.
No, I'm just adding to your female suggestion. I do find that when I run across women that are like, well, I'll let my husband do it or whatever. I say, wait a second, who does the shopping in your house? Well, I do. Do you know what things are going off the shelf? Do you know what the kids are buying? Do you have a feel for what's happening in the world? Really, and not just numbers. You can see it happening. You got to trust your gut. I mean, you work with men and women. I do believe that. But women have different advantages in that a lot of times I think they're just out there and they see different things. They pay attention to what their kids are doing at school, buying and trends and that sort of things.
I totally agree with you from the perspective of women's intuition, getting to know a manager. I get spidey senses about things. I mean, I'm not going to tell the whole story because it's too long, but there was a company that got in big trouble. And it was the CFO that really was the architect of the trouble. And the CEO ended up taking the fall for it. I told the CEO a year before it happened, when I had dinner with him and the CFO, I said, that guy's a bad guy. I said, you want to watch him? And we got into a huge fight. He's like, that's my CFO. How can you say that? I trust him, blah, blah, blah. And I'm like, I'm telling you, that's a bad human and something bad is going to happen. And it's a famous story. I'll tell everyone offline. I don't want to be, but well, I'll tell you, it was Enron. It was Enron. And Jeff Skilling went to jail for 12 years because of what Andy Fastow did. And because he turned quicker. And Jeff, to this day, if you called Jeff Skilling, he would say, she told me. But so I think women are great at that. And by the way, I don't always get it right, but when I really have that strong feeling, I'm usually not wrong.
Yeah, go ahead, Howie.
Yeah. So, Ellen, one of the things that we spoke about was how you go about finding opportunities that are off the grid, so to speak.
A lot of them come to me because I deal with family offices and people, as I mentioned earlier, who want something a little different. Sometimes it's just early stage. Sometimes, I kind of like the tech, AI, but show me something I haven't seen. I get people coming to me all the time with these ideas. I personally, yes, I do my due diligence. I'm part of a broker dealer. I have to do all that. But I need to go in the office. Okay, we're working virtually. No, I need to meet you. It doesn't work doing Zoom. I had somebody
Zoom's a great place to start, but yes, you have to meet people in person.
I had somebody come to me who had incredible CV and, on this board and that board, supposedly. They had done 200 million before, but it wasn't really a fund, personal investments. And I had 26%. And I have offices all over the world. And I thought, this is interesting. How much have you circled already? 150. What do you need? Okay, fine. And I tried very hard to meet her in various different places where I was, and she was just the day before. I didn't send, I take that back. I have someone I know who invests in women owned, and a minimum of 50 million. And I said to her, Michelle's going to be out in California where you are. Can you spare some time? And somehow it just didn't work out. And I thought, if you don't make an effort, if they just smelled a rat like you're talking about, I said, thank you very much. It's not for me. I don't want to put someone forth who I just don't believe is honest
Well,
and straightforward and willing to go the 9 yards.
Yeah. And I'll tell you a quick Zoom story that a psychologist just told me. She started seeing a patient during COVID. So she was seeing the patient virtually, and they had developed this relationship, and the woman had some problems and some issues. But the psychologist couldn't quite get to the bottom of what it was. And it occurred to her that they had never met in person, and she wasn't maybe getting the whole picture. So in the next session, she said, and the woman was apparently a very attractive woman, but she only saw her from, here up. No, it wasn't AI. Only saw her from here up. So she said, you know what? It occurs to me we've never met and we should see each other. So she said, I'm going to stand up, step back from the camera so you can see me and what I really look like. The woman stood up and weighed 400 pounds. And the psychologist was like, I now understand all these problems she was having. And the woman's now lost 150 pounds. She got a boyfriend for the first time in her life. And the psychiatrist was able to help her. But not having seen that, and it's similar to meeting people in person, it's really important.
Lindsay.
Okay. Yeah. I really promised to be quiet for a long time. So here we go. I don't necessarily agree with a lot of the ways that we've been discussing different genders and everything. I have 2 daughters. In my vows, I said I would have like a clean house and food on the table, but I would not provide either. I don't cook. I don't clean. I do have spidey senses, but I don't want to raise my girls to think that, that's the goal here. And so I'll take one event that happened earlier this year and deconstruct it for you guys so you can understand what's happening in the industry with allocation directions. And then to Marty's point, I'll discuss the bubble that I see forming that we should all just be cognizant of. So earlier this year, and some of you were actually there, I was invited to an event that was in a built like a very, very high tower floor, like in Hudson Yards, so high up I had vertigo, but it was like women executives of Wall Street invited to go see a woman produced documentary about female funders funding female founders. Like, you could not pack more estrogen into this room if you tried. And it was a great event, and it made a lot of connections, and it was, so many good things. I'm friends with the producer now, all that sort of thing. But from my perspective, like, why was this entity doing this whole estrogen fest? And it's because of the asset flows and the dearth of relationships with, females that are controlling the money. And it's kind of a feeble attempt to start building those relationships, right? So that just think about how the industry is trying to do that. Now, the bubble, so many private equity funds, right? Larry Fink actually, in his letter this year was mentioning like kind of the atrocities of how many people are under allocated to their retirement accounts. And now it's democratized. Everybody can invest in alternatives in their account. One of the big problems is, I would say, let's take a typical RIA these days, right? Backed by a private equity firm that's saying you must grow your revenue. The way you do that, you make these tiny acquisitions from like DePaul and like, I don't know, Albuquerque, right? And you make the firm makes these decisions, and there's not necessarily an active feedback loop from the investment team at the top that is saying alternatives mean X, Y, Z, and the DePaul person who might have not ever seen an alternative in their life that is now offering out to their clients alternatives to go into their 401ks, which might get stuck. right? And if those alternatives for somebody that doesn't understand the risk reward and when they need their money can't get their money back, and there's just all this inherent trust in the system that it's now an acceptable allocation, there's the potential for a big bubble there, similar to what's happened at the top with the endowments getting stuck with a lot of, privates, can happen in like everybody's 401ks. Financial literacy and communication and transparency.
I think what's worse in 401ks is that people who have the 401ks don't really understand
Exactly.
our business well enough. And
Shouldn't be.
they
doing
don't
that.
understand that a lockup really means you cannot have your money back. Right.
Nor should they. They have a different job every day for a living. Why should they become investment experts? And that's the problem. And the problem with defined benefit programs was that they were on companies' balance sheets and they played games with them.
And I
So
would also argue
it should be.
And I would also argue in the 401k situation, the players who are going to be able to get those dollars are the brand name players, which aren't necessarily the best players to be investing with.
And the product that they're putting that you can buy that way is not the product we as
Correct.
institutions can buy.
Correct.
So the name is
It's
there,
dumbed down.
but you have a very different investment.
So we have about 2.5 minutes. Is there any other questions from the audience? Or should I just let these guys keep going?
We can pick on the people in the front row.
That's right. Steve, what do you got?
You want me to ask a question? Victoria.
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 Yeah, we always watch the trends. We all know each other. Everyone. So before 2022, the trend was, do you have an amazing deal? Do you know another amazing family? Fund manager. Everybody was showing the green button. So as you know. Hello, everyone. No, press the green button. No, it's a red button. I'm gonna just yell the word. It should work. Before 22, everything was about access, deals, ideas, and everybody was treating all. And now it's all about, we don't have liquidity. So I have never seen so many good funds, so many direct deals. I just got another 100 million of Anthropic. Anybody wants it? My point is that everybody has a lot of things to invest in. Nobody has cash, right? So it's boring, but all I've been doing is helping people to
So
invest in
Victoria,
the story.
our families have cash. What they've managed to do over the years, because we don't control all their assets, they have managed to do exactly what you said. They've overinvested in illiquid private equity long-term, of overinvested in venture, overinvested in direct lending, overinvested in real estate. So they are uncomfortably illiquid. They aren't broke. And by the way, because I'm in the business, pension managers call me because they can get an unbiased opinion that nobody's ever going to hear about. The institutions have done exactly the same thing as the family offices have, which is ironic because in 2012, everybody wanted liquid, had to be liquid. Like I got to get my money back tomorrow. And the pendulum has just swung too far. So this is
but
going to work
there's
itself.
a bigger issue too in the endowment and foundation space anyway, because as we know, private equity and locked up vehicles don't get marked in the same way that public vehicles get marked. So there's no mark to market. And if you're running an endowment and you're required to pay out 5% a year on $1 billion, but you're the CIO and you know your $1 billion is really 900 million because those private equity books haven't been marked or the accountants haven't taken the haircut, you're still paying out 5% on $1 billion. So that also ties up cash not to be able to invest.
So I think our time has run out. But I do want to make one important public service announcement. Marty spoke about an email that he received. And the public service announcement is so many of these emails that we receive are phishing scams. And they're asking us to click. And I'm part of Park Avenue Securities. And every once in a while, we get phishing emails sent to us from Park Avenue Securities to see if we pass the test or not. And it's unbelievable how it's come to the point where I look at every single email now, wondering if Suzanne really sent me that email. And it's a bit scary, but I think that we just all have to take heed that everybody's trying to get our information and not in the best way possible.
I was about to tell you, I'm an old tech geek. I program computers. when you see the name Suzanne, hit it again, and it's going to show you the actual underlying address that it came from. And it should be something that makes sense.
And it also embedded links. Scroll over them, because it might, for example, say like Gmail or might say like a company, but when you scroll on the link, it's like a broken link that's trying to fish you out to somewhere else.
Nope.
So check where like the .com and the / check where it's going
Don't
to.
click any link.
Fantastic.
Don't click it.
Great job,
Don't click
guys.
any link.